Now let's turn to the second half of the Fed's dual mandate, and arguably the stickier problem right now, inflation. You've seen the headlines. You've felt it at the supermarket, the gas station, and probably in your rent. Inflation isn't falling as fast as many hoped. Despite a softening job market and slowing GDP growth, the cost of living continues to grind higher, especially in core services. Let's talk numbers. In Q1, the Employment Cost Index came in above expectations. That means wages, benefits, and labor-related costs are still rising. So, while the economy is clearly slowing in parts, prices are proving resilient, especially in sectors like housing, healthcare, and insurance. And that puts Powell and the Fed in a tricky position. If they cut rates too soon, they risk undoing progress made on inflation. Lower borrowing costs could fuel new demand, which might send prices even higher. This is the dilemma. The labor market is starting to weaken, yes, but inflation is still too sticky to ignore. Cutting rates now might offer short-term relief, but it could lead to long-term pain if inflation expectations become unanchored again. And Powell knows this. In recent speeches, he's made it clear. The Fed isn't just looking at job numbers. They're focused on price stability, and they want clear, consistent disinflation before making a move. So where does that leave us? Even if the job market weakens more in the coming months, the Fed might not respond immediately. Not unless inflation gives them room to do so. Until then, the Fed is likely to stand firm, signal patience, and wait for both pillars of its mandate, employment and price stability, to align. Because one without the other isn't enough to justify a rate cut.